Hey everyone, this is Mike DeBlis. Welcome back to the webinar on demystifying the FBAR. We're now into Module 2, which is the second half of deconstructing the FBAR rule. As you might recall, in Module 1, we covered the first three elements of the FBAR rule, and now we're going to pick up where we left off. And what better place to pick up or to segue into Module 2 than on the pivotal issue of what it means to have a financial interest in a financial account. A U.S. person has a financial interest in several situations. The ones that I've listed for you are by far the most common situations that exist here. And now I'm going to ask you for your indulgence because this can be very dry. However, these issues come up time and time again, so now is no time to doze off. I'll do my best to provide you with some examples to drive home these situations so that you understand them as thoroughly as possible. In the first situation, the U.S. person is the owner of record or holder of legal title, regardless of whether the account is maintained for the benefit of the U.S. person or for the benefit of another, even if that other is a non-U.S. person. In the second situation, the owner of record or holder of legal title is a person acting as an agent, nominee, attorney, or a person acting on behalf of the U.S. person with respect to the account. The example that I'm going to illustrate here focuses on the second half of this situation, namely a person acting on behalf of the U.S. person with respect to the account. So we have John. John's a U.S. citizen. He has a brother. His brother's name is Paul. Paul maintains bank accounts in Mexico on John's behalf. The accounts are held in Paul's name, but Paul only accesses the accounts pursuant to John's instructions. The first issue is whether John has a financial interest in the Mexican bank accounts for FBAR reporting purposes. If you answer yes, you're spot on. He most certainly does. But how about Paul? Well, if Paul is a U.S. citizen or resident, he too has an FBAR reporting obligation with respect to the accounts. Why? Because he might be what you'd call a person acting on behalf of the U.S. person that has an ownership interest in the account. And who might that U.S. person be? None other than his brother, John. Here's our third situation. This is when the owner of record or holder of legal title is a corporation in which a U.S. person owns directly or indirectly greater than 50% of the total value of stock or greater than 50% of the voting power of all shares of stock. So what we're dealing with in this situation is one where the corporation is the owner of record or holder of legal title, number one. And number two, a U.S. person owns directly or indirectly a majority share of the total value of stock or a majority share of the voting power of all shares of stock. And when I use the term majority, I'm specifically referring to greater than 50%. Notice that it's or and not and. So if the U.S. person owns more than 50% of the total value of stock, but not more than 50% of the voting power of all shares of stock, he still satisfies the rule. Or in this case, the corporation still satisfies the rule for FBAR reporting purposes. Again, it's either or. Similarly, if the U.S. person doesn't own more than 50% of the total value of stock, say he owns only 49%, but if he owns more than 50% of the voting power of all shares of stock, then that would be enough to push the corporation above the FBAR threshold reporting requirement, and in that case, the corporation would have to complete an FBAR. So let's take a look at example number 1. We have a Minnesota corporation, and that corporation owns 100% of a Spanish company. The Spanish company maintains several foreign bank accounts. Not surprising. Must the Minnesota corporation file an FBAR? Yes. Why? Well, the Minnesota corporation is a U.S. person, number one. Number two, it directly owns more than 50% of the total value of the shares of the Spanish company. Keep in mind that the first fact that we were given right out of the gate is that the Minnesota corporation owned 100% of the Spanish company. And finally, the Spanish company has legal title over several foreign financial accounts. So that explains why the Minnesota corporation must file an FBAR. Again, just to recap, the Minnesota corporation is a U.S. person. Second, it directly owns more than 50% of the total value of the shares of the Spanish company. Here we are told that it owns 100% of the shares of the Spanish company. And finally, the Spanish company has legal title over several foreign financial accounts. So yes, the Minnesota corporation must file an FBAR. Let's take a look at example 2. And in example 2, we have Jack. Let's assume that Jack is a U.S. person and that he owns 75% of the Minnesota corporation in the last example. Must Jack also file an FBAR? Yes. Why? Well, in this case, he indirectly owns more than 50% of the total value of shares of stock of the Spanish company. And we know that because we see here that he owns 75% of the Minnesota corporation. And recall that the Minnesota corporation owns 100% of the Spanish company. So we know for a fact that Jack owns more than 50% of the Spanish company. All right, it's a little bit convoluted here because Jack owns the Spanish company through the Minnesota corporation. As indicated above, it says that he owns 75% of the Minnesota corporation. But because he indirectly owns more than 50% of the shares of the Spanish company, and because the Spanish company is the record holder of several foreign financial accounts, Jack has to file an FBAR. In this situation, the owner of record or holder of legal title is a partnership in which the U.S. person owns directly or indirectly an interest in greater than 50% of the partnership's profits or an interest in greater than 50% of the partnership capital. It's not unlike the rule regarding corporations that we just discussed in the last slide. In this situation, the owner of record or holder of legal title is a trust, of which the U.S. person is the trust grantor and has an ownership in the trust for U.S. federal tax purposes. Now, it's very easy when you're looking at this situation to overlook the fact that we have "and" as the conjunctive here, not "or" as the disjunctive. So the owner of record or holder of legal title is a trust. That's number one. And number two, the U.S. person must A, be the trust grantor, and B, have an ownership interest in the trust for U.S. federal tax purposes. It's not or. In other words, if the U.S. person is a trust grantor but does not have an ownership interest in the trust, then there is no FBAR filing obligation. Here's an example. We have Diana. Diana is a U.S. citizen. She's a grantor of a foreign asset protection trust, but she doesn't control the trust's assets, nor does she receive distributions from the trust. Must Diana report the trust's foreign financial accounts on an FBAR? Yes. Why? Well, we already know that she's the grantor of the trust, and that is our first condition that we have to satisfy. And because she's a grantor, she is deemed to be the owner of the trust assets for federal tax purposes. So she satisfies the second condition, where the U.S. person must have an ownership interest in the trust for federal tax purposes. Moving on to our next situation of when a U.S. person has a financial interest in a financial account. That's when the owner of record or holder of legal title is a trust in which the U.S. person has a greater than 50% present beneficial interest in the assets or income of the trust. So that's a veritable mouthful. So let's go back again. In this situation, the owner of record or holder of legal title is a trust in which the U.S. person owns more than 50% beneficial interest in the assets or in the income of the trust for the calendar year. Here's an example. We have Amy. Amy's a U.S. citizen. She has a remainder interest in a trust that has a foreign financial account. Must Amy report the trust's foreign financial account on an FBAR? No. Why? Well, this is something that you may not, that's not readily obvious, but because she has a remainder interest is not considered a present beneficial interest for FBAR purposes. So you're beginning to see now that there are a lot of nuances and a lot of concepts that fall outside of the foreign asset reporting realm that sometimes rear their head when it comes to this concept of whether a U.S. person has a financial interest in a foreign bank account. In our next scenario, the owner of record or holder of legal title is any other entity in which the U.S. person owns directly or indirectly more than 50% of the voting power, total value of equity interests or assets, or interest in profits. So you might consider the last situation to be a catch-all. Let's take a small diversion now into reporting jointly held accounts. This comes up fairly frequently when it comes to FBAR reporting. Let's assume that we have two persons who jointly maintain a foreign financial account. The general rule is that each person has a financial interest in that account. Therefore, each person must report the entire value of the account on an FBAR. Now, I don't want to mince words here, and I want to be very, very clear. This rule means exactly what it says. Now, we are going to talk about some exceptions, but I want to be very clear that if there are two persons, two people who jointly maintain a single foreign financial account, each one of them is considered to have a financial interest in that account. And each person must report the entire value of the account on the FBAR. So let's say John and Sally both have a own a foreign financial account. They jointly own a foreign financial account. And let's say that the high watermark balance of that account is $150,000 US. Well, not only does each of them have to report that foreign bank account on an FBAR, but they must report the high watermark balance of that account on the FBAR. It's not something where they get to split it up and say half of the highest maximum balance can go on John's FBAR and half of the maximum aggregate balance can go on the other joint owner's bank account or other joint owner's FBAR. The entire value must be listed on the FBAR of both joint owners. And here we see an exception for spouses. Must the spouse of an individual who files an FBAR file a separate FBAR? The answer is no, but only if the following conditions are satisfied. So again, this is the scenario where you have a couple. Let's say we've got John and Susie. Now let's say that John has an ownership interest in a foreign bank account, and John files an FBAR reporting that foreign bank account. The question here is whether Susie has an obligation to report that account on a separate FBAR. All right, now again, we're assuming that both John and Susie have a joint interest in this foreign bank account. The answer here is no, but only if the following conditions are satisfied. All the financial accounts that the non-filing spouse is required to report are jointly owned with the filing spouse. So essentially, in the example that I've given you, the non-filing spouse would be Susie, because we've already established that John has filed an FBAR reporting his interest in the foreign bank account. And the first condition is satisfied if all the financial accounts that Susie is required to report are jointly owned with John. In this case, they are. In the second condition, the filing spouse, here John, actually reports the jointly owned accounts on a timely filed FBAR, and one that's electronically signed. For purposes of this hypothetical, we've assumed that John has reported the jointly owned accounts on a timely filed FBAR. And finally, the filers have completed and signed Form 114A, which is the record of authorization to electronically file FBARs. We've satisfied that as well. So in this hypothetical, Susie, as the non-filing spouse, does not have to file a separate FBAR because all the conditions are satisfied. But you can easily see how, with one of the conditions not being satisfied, how the IRS would have some very tough questions for why Susie failed to report her joint interest in the account on a separate FBAR. Keep in mind that that all three conditions must be satisfied in order for the non-filing spouse, here Susie, to not have any obligation to file a separate FBAR. And as I explained, as I've already explained, if just one of these conditions isn't met, then both spouses must file separate FBARs, and each spouse must report the entire value of the jointly owned accounts. What does it mean to have signature authority over a financial account? Well, let's not leave this to speculation. let us define what it means to have signature authority. The IRS defines signature authority as the authority of an individual to control the disposition of assets held in a foreign financial account by direct communication to the bank or other financial institution that maintains control over the account. What a mouthful. Let me try and break this down as simply as I can. Signature authority is the equivalent of having control. There's a theory in criminal law called constructive possession where we can draw a nice parallel. It's a situation where the police pull over a car, and for one reason or the other, they obtain consent of the owner of the car to do a search because they have probable cause to believe that there is something illegal that might be found inside the car. They have they have the driver and the passenger, meaning all the occupants, get out of the car and they conduct a search. And let us say that they find a gun inside the car. Well, the normal practice is for the police to charge everyone with possession of that gun under a theory called constructive possession. Now, while that gun might have been found right under the front passenger seat, and thus within closer reach of the front passenger than any other passenger in that car, it still is, everybody in that car is still charged with having constructive possession of it. And the theory of constructive possession basically states that every person that was in that car had the ability to access the item in some way, shape, or form. It was within their reach. They could have accessed it, and they could have used it for some nefarious purpose. In this case, God forbid, to fire it or to shoot it. There is, of course, a mental element that the government has to prove in a constructive possession situation, meaning the government has to establish that there is enough evidence to suggest that that an occupant of the car knew that the weapon existed. And the reason why I've taken a little detour into constructive possession is because, again, there are some parallels that can be drawn between that theory and between the authority of an individual to control the disposition of assets held in a foreign bank account. All we're saying here is that in a situation involving a foreign financial account, the U.S. person has the authority to control the assets that are inside that account. So he or she may not necessarily own the account or have an interest in the account, but by the mere fact that he has signature authority over the account and can control where the assets go, meaning can do a wire transfer or can send them wherever he or she wants, that is enough to satisfy the definition of signature authority. And if that level of control exists for there to be signature authority, then the taxpayer has to report the account on an FBAR. And again, it's saying that there has to be the authority to control the assets in the account has to be one that can be accomplished through direct communication, meaning in writing or perhaps by the taxpayer calling the bank or member or a bank representative up and requesting that this transfer happen. Here's an example. We have Megan. Megan is a U.S. resident. She has a power of attorney on her elderly parents' accounts in Canada, but she has never exercised that power. Must Megan file an FBAR reporting her parents' Canadian accounts? Yes, but there's a condition attached to it. Only if that power of attorney gives Megan signature authority over the financial accounts. So that's interesting here. We know that she has power of attorney. We know that her parents are elderly. And she's never exercised the power of attorney. So it would be easy to speculate without doing some digging that Megan may not have an FBAR reporting obligation, meaning to report her parents' Canadian accounts on an FBAR. But that's only partially true. If the power of attorney gives her signature authority over the financial accounts, then she must report those accounts on an FBAR. But if the power of attorney did not give Megan signature authority over the financial accounts, then she has no obligation to report the Canadian accounts on an FBAR. Whether or not Megan ever exercises that authority, meaning that signature authority, is meaningless for purposes of the FBAR filing requirement. Now we move on to the maximum account value rule. The maximum account value is defined as a reasonable approximation of the greatest value of currency or non-monetary assets in the account during the calendar year. So, how is the maximum account value determined? And what I've done for you here is I've broken it down into two steps. First, determine the maximum account value of the account during the year. Second, convert the maximum account value for each account into US dollars using the exchange rate in effect on the last day of the calendar year. So, what you're going to need to do here is gather up all of your foreign bank account statements for that particular account and go through them one by one. Typically, they are issued monthly, and what you'll want to do is keep tabs on what the highest balance was for each month. After you determine what the highest balance was for each month, you might want to put those values in a spreadsheet and then evaluate them, put them side by side, meaning put the high balance for each month side by side and select the balance that was the highest during the year. That is the maximum account value for that account during that year. Now, of course, you're not done. At that point, you have to do what's called a conversion, because you may have what you may be dealing with is what you may be dealing in rather is euros. That might be the currency in the foreign account that you own. So what you need to do, of course, is convert that amount from euros into dollars. And of course, you need to know what exchange rate to use. And what we've been instructed, or what the IRS is telling us, is that we have to use the exchange rate in effect on the last day of the calendar year. Here's an example. In 2014, Todd had a foreign account with a Japanese bank. How would Todd determine what his maximum balance was for that account for 2014. First, he would determine the maximum value of the account in yen, which presumably is the currency that the bank trades in. Second, he would convert the maximum value of that account into US dollars using the exchange rate in effect on December 31st, 2014. Oh, and in order to find out what the exchange rate was, you can do a very simple Google search and type in the keywords exchange rate from yen to US dollar, and then December 31st, 2014. It'll pop right up. What type of documentation can the taxpayer rely upon to determine the maximum balance of his or her foreign account? Well, as you see here, periodic account statements are what are most typically used to determine the maximum balance of a foreign account. But again, the caveat here is that they fairly reflect the maximum account balance during the calendar year. I have come across some account statements from foreign bank accounts that were like reading hieroglyphics and were utterly useless for purposes of determining the maximum balance. Most, however, do contain that information, but it's not readily obvious. Now we turn to the question of the maximum aggregate value rule. This is what stifles a lot of taxpayers who are working their way through one of the IRS's voluntary disclosure programs, or just plain filling out FBARs. And here are two examples to drive home the concept. I'm going to preface these examples by telling you that they are very basic examples. And as you will soon see, this gets a lot more complicated than the easy take-home examples that are to follow. So in this example, number one, we have three foreign accounts. We have account A, account B, account C. And this taxpayer has recorded the highest balance for 2010 in each one of the accounts. We also know from looking at the chart that the conversion has already been made from foreign currency into US currency. So for account A, we have a high balance of $25,000. For account B, we have a high balance of $35,000. And for account C, we have a high balance of $40,000. So what is our maximum aggregate balance for tax year 2010? And I'm going to assume, for purposes of this example, that it's only these three accounts that the taxpayer had for tax year 2010, and that there were no others. So what we're going to do is we're going to add up $25,000, $35,000, and $40,000 and arrive at $100,000. That would be our maximum aggregate balance for tax year 2010. Here is our second example. Let's assume that John has highest balances of which never exceed $10,000. The highest balance in each account is $9,000. Now, you might pause for a second and say to yourself, Mike, didn't you tell me earlier in this slideshow that there has to be there's only an FBAR reporting obligation if the account crosses a threshold of $10,000 US in the tax year? You would be 100% correct. That is spot on. The FBAR reporting requirement is triggered only when the account exceeds $10,000. However, the maximum aggregate value rule muddies this up a little bit. How so? Well, what the maximum aggregate value rule tells us is that for purposes of determining whether we've crossed the $10,000 threshold, we have to first aggregate the highest balance of all of our accounts in a single tax year. So we cannot look at each account in isolation and say, well, account A falls below the $10,000 threshold, account B falls below the $10,000 threshold, and account C falls below the $10,000 threshold. So by Jesus, I have no FBAR reporting obligation. If that was the logic running through your mind, unfortunately, you would be wrong, and you probably would be among the majority that had interpreted it this way. Instead, what the IRS is telling us here is that before we can apply the $10,000 threshold rule, we have to aggregate all of these amounts. And what happens when we aggregate the highest balances of each of these accounts? Well, that takes us to $27,000. And so, although none of the accounts by themselves trigger an FBAR reporting requirement because no single account exceeds the $10,000 reporting threshold, together they do. As we've already identified, the highest aggregate balance of the three accounts is $27,000. Therefore, all three must be reported on an FBAR, even though none of them alone triggers an FBAR reporting requirement. So this takes us to the end of Module 2. As I have mentioned to you in previous webinars, I welcome any and all questions. Feel free to email them to me or to call me with any questions. What I provided for you is very general information. It is not specific to your individual circumstances. What I do is I provide a risk assessment that thoroughly takes into consideration the facts of your particular case, and I apply them to these very arcane rules in order to help you navigate the choppy seas of foreign asset reporting. So that is how can I put it, a soft way of saying you cannot rely on what I provided you for your particular case. If you have any specific questions, please reach out for me or for another tax attorney, and I'll be happy to help, as I'm sure most of my colleagues would be as well. So this brings Module 2 to an end. I look forward to presenting to you Module 3.